Welcome to India's ultimate investment showdown because India's mutual fund market is booming like never before. With new investors jumping in every day, but with thousands of options and thousands of schemes, how do you pick the winner? That's right, you can't. But that's exactly what Outlook Money's latest issue, India's Best Funds, is about. And we're going to break down today what you need to know in the simplest of terms. So, let's play Smart Investing. Mutual funds come in many flavors. Active, passive, direct, regular, equity, hybrid. It can get very confusing very fast. So what's working and what's not? Let's simplify it. First up, we have active funds and we have passive funds. Now, active funds have fund managers trying to beat the market by picking stocks. Now, that sounds great, right? But active funds don't consistently outperform the market benchmarks for over 10 or 15 years. So passive funds simply copy a market index like Nifty 50. They keep the costs low and often deliver better long-term results for regular investors. Now, next up, we have direct plans versus regular plans. Now, direct plans are those in which you invest straight through a fund company. Now, here you avoid middleman commissions. That means you can save up a lot of money and actually add thousands more in returns over the years. And on the contrast, we have regular plans which are basically sold through intermediaries who earn commissions. Now, this can lead to a higher expense ratio and at the same time lower returns for the investor. Now, let us talk about funds, which are equity funds, hybrid funds, and debt funds. First off, equity funds invest in stocks, which means that there are higher rewards but at the same time potentially higher risks. Hybrid funds mix both stocks and bonds. They're like this, they try to be this best of both worlds kind of situation, and they try to balance the risk at the same time the rewards, and they're basically like this smart safety net. And debt funds invest in bonds, which means that there is lower risk, there are steady returns, and they're especially great when the interest rates fall, just like we have seen recently. Joining us now is the author of this cover story, Mr. Kundan. Thank you so much for joining us today.
Thank you, Shivam. Thank you so much.
So, a quick question, Kundan. What inspired you to write this story? And what is something that investors should take away from this?
Shivam, basically, this is not the first time we have done this. It is the third time in a row. So every year in June issue, we do the best funds issue. As far as inspirations are concerned, the one thing is very clear. Typically, what happens when when you want to invest, typically you do research on funds, which funds are doing well. So basically, you can say that this is not the best fund. This is the best fund on risk-adjusted return basis. How smartly the fund manager is managed to deliver the returns. Okay, so this will help our readers make informed decision.
So, in your research, it comes up that active funds don't really beat the market over a period of time. So, are you suggesting in your cover story that investors should actually switch to passive funds? Is that what we are getting at?
No, not at all. Here, our idea is not to tell our readers that investors should switch to passive funds. In fact, both active and passive funds go hand in hand together because India is a emerging market, right? If a fund is underperforming its benchmarks, say in 1 year or say 3 years, it doesn't mean that a fund cannot outperform in long term. So basically, investors should look at the fund which have consistently delivered better returns as compared to the benchmark. So the best strategy would be to invest in both active as well as passive. So that would be the right strategy to make most out of the market.
And what about equity and debt funds? Like, how do they play a role?
if you look at mutual funds, there are multiple categories like equity funds. Within equity, there are multiple subcategories like large cap equity funds, mid cap, and they all serve different types of investor, different needs of investor, right? So if you look at equity funds are for long term financial goal, financial goals, right? Similarly, debt funds, that is for conservative investor who doesn't want to take equity risk. There is one category that is hybrid, that invests in both, that helps you to take advantage of both the world, equity as well as debt. So if somebody wants to take equity returns but not very high, but not willing to take higher risk, so in that case one can go for hybrid funds.
And what do fund ratings mean? And should actually investors choose their funds according to their ratings?
Very good question. Right. So let me explain this to you about rating. See, the rating is done by our knowledge partner, Morningstar. Okay. So when we do the rating, this is not the ranking. There is difference between ranking and rating. We rate based on our knowledge partner rate funds based on various metrics. They take into consideration various metrics like alpha, how the fund manager has generated alpha, what is the capability of the fund manager to protect the downside of that particular scheme. So broadly, we have taken multiple metrics, but in broader sense, there are two metrics, that is risk adjusted return and another is uh, the probability of downside, right? Containing the ability of a fund manager to protect the downside. So these are the two parameters. Based on that, we have ranked the fund. Rating gives you an idea how the fund has performed in the past. So that gives you a sense of consistency. A consistent performer funds will get higher return. Rather, the hot fund which have given just best return in shorter period, but the fund has underperformed in long run. So this rating gives you an idea about the consistency of the performance of a particular scheme.
And what about OLM 50?
LM50 is our hand-picked mutual fund schemes, which any new investor can refer for investments. Basically, we have listed 50 schemes across categories over there. So suppose if you are a new investor and want to invest in a mutual fund, so where you go? Typically, you go to various websites. You will see the past performance, present performance, 1 year return, 3 years. But that will not give you the idea how the fund is, whether the fund has consistently performed well. So this could be one-stop solution for any new investor. You can just pick up Outlook Money Magazine, go through OLM 50. We have done all the research for you. So what you need to do, if you want to invest in a large cap, just go through schemes, pick one.
Thank you for the insights, sir.
Thank you, Shivam. Thank you so much.
And now for our viewers and our readers, I would like to say that we are going to link this entire Outlook Money story in the description. So do check it out.
In the end, investing smart just means understanding your options, whether they are active, passive, direct, regular, equity, or debt, and then building a solution that suits your goals. So, take control, choose wisely, and let your money grow.